Welcome, curious minds. Today we're doing a deep dive into the latest financial results from Coforge Ltd.
That's right. For the first quarter of their fiscal year 2026, the period ending June 30, 2025.
And we've got quite a bit to work with here. There's a detailed investor presentation, the official press release, the outcome of their board meeting too.
Plus a whole set of internal questions we put together to really, dig into the details behind the headline.
Exactly. Our goal here isn't just to read off the numbers. We want to extract the key insights, give you a shortcut to understanding Coforge's performance, their strategy.
And importantly, what it all means for them in the, well, let's face it, very competitive IT services market.
Yeah, it's about getting beyond just the what to the why.
Precisely. Understanding the context, how these results connect to the bigger picture, the industry trends, that's where the real value is.
Okay, so let's dive in. Let's start with the big picture numbers, the top line. Coforge reported overall revenue for Q1 FY26 at INR 36,886 million.
Which translates to about US $442.4 million.
And the growth rates, well, they definitely catch your eye. Quarter on quarter, revenue grew 8.0% in constant currency.
8.2% in rupee terms, and a strong 9.6% in US dollars.
But then you look at the year-on-year growth, and it's, wow, pretty dramatic. Revenue up 51.5% in constant currency.
56.5% in INR, 54.5% in USD. Whoa.
Yeah.
But hang on, that massive year-on-year jump, it needs a bit of context, doesn't it?
Absolutely. Good point.
It's really important to remember that the Q1 FY25 numbers, the comparison figures from last year, they've been recasted.
Right.
Meaning they took out the revenue from AdvantageGo, that business they sold. So it's not quite an apples-to-apples comparison with the original number from last year.
Makes sense. It levels the playing field for the comparison. So we're looking at the underlying growth of the continuing business.
Exactly. Without knowing that, you'd think something almost unbelievable happened year over year. It's still very strong growth, but the recasting explains the sheer scale of that percentage jump.
Okay, that context is crucial. Now let's talk profitability. They reported net profit, or PT, of INR 3,174 million.
And that's up a huge 138.4% year on year, even with the recasted base, and 21.5% quarter on quarter. Also very strong.
And their EBITDA margin came in at 17.5%. Importantly, that expanded by 61 basis points compared to the previous quarter.
Yeah, that margin expansion, almost 2/3 of a percentage point improvement in just 3 months, that's quite telling.
What does it tell you?
Well, it's just they're not just riding a wave of demand. They're managing their operations really effectively, getting more profitable in the work they do.
So operational efficiency.
Definitely. Maybe better utilization, maybe leveraging technology like AI internally, better project management, whatever it is, they're squeezing more profit out of that growing revenue.
Yeah.
In this market, that's key.
Okay, so strong top line, strong bottom line. Now this is where it gets really interesting, I think, the business development side. Order intake was robust. US $507 million just in this quarter.
That's a healthy number. Shows the pipeline is converting well.
And they highlighted strong momentum in large deals specifically. 5 significant deals signed across North America, the UK, and APAC.
Big deals are important. They provide a solid foundation, often longer-term engagements.
And that feeds into their executable order book for the next 12 months. It now stands at US $1.55 billion.
Wow. And that's up nearly 47% year on year, 46.9% to be precise.
Yeah, 46.9%. That gives them huge visibility into future revenue, right?
Absolutely. That kind of order book growth combined with a high repeat business rate, what was it, 94.5%?
Yeah, 94.5%.
That tells you clients are sticking with them, giving them more work. It's not just about landing new logos, though they do that too.
Right, 6 new client logos added this quarter.
But keeping existing clients happy and growing those accounts, that's the bedrock of a sustainable services business.
And speaking of clients, they also mentioned they're de-risking their client profile. Client concentration is down.
How much down?
Top 5 clients are now 20.7% of revenue, and the top 10 are 29.3%.
Okay, so less reliance on any single big customer. That's a strategically smart move.
Why is that so important?
Well, it just reduces vulnerability. If one major client hits a rough patch or decides to switch vendors, it doesn't sink the ship. It provides more stability.
And they're growing clients across different sizes, too.
Yeah, you mentioned they have, what, 32 clients now above the $10 million mark?
That's right, 32.
See, that diversification across more high-value clients makes the whole business more resilient long-term. It's a healthier base.
Let's shift gears a bit to their strategic priorities. The CEO, Sudhir Singh, He talked about a pathway to 14% EBIT in FY26.
EBIT, so earnings before interest and taxes, a key profitability metric, setting a clear target there.
And he also emphasized aiming for their 9th consecutive year of sustained, robust growth. So the ambition is clearly there.
Growth and improving profitability, that's the balancing act.
But beyond just the numbers, their focus on AI seems quite significant. They mentioned the Quasar AI marketplace, the Agent Sphere library, which apparently has over 100 foundational agents ready to go.
Foundational agents, what for?
Specifically for industry pain points in travel, financial services, and healthcare.
Okay, so targeted, practical AI applications, not just generic stuff.
Seems like it. Plus, they're using something called ForgeX, their own AI platform for actual delivery like application development and modernization.
You know, that actually sounds quite grounded. A lot of companies talk a big game about AI, but building specific tools like agents for pain points and key verticals, that feels more tangible.
More practical.
Yeah, more practical. It suggests they're trying to use AI to solve real client problems now, not just talking about future possibilities. That could be a real differentiator moving beyond the hype.
They also racked up quite a few industry recognitions, positioned as a leader by Avison, ISG, Nelson Hall, in areas like airlines, Duck Creek, and ServiceNow services.
Like I said, the third-party validation of their capabilities in specific niches, that helps build credibility.
And they got a Sustainable Organization 2025 award. Plus, key partnerships, they hit Microsoft Solution Partner status across all 6 areas.
That's quite an achievement with Microsoft. Shows deep expertise across their cloud stack.
And partnered with Zscaler for secure access stuff via the Azure Marketplace.
Good ecosystem plays. Important in today's cloud-centric world.
Okay, let's talk about the people, the foundation of a services company, right?
Absolutely critical.
Their total global headcount is now 34,187 as of the end of June.
Okay.
But what really stood out was the net addition of 11,164 people during the quarter.
A net addition. That's interesting.
Yeah, especially, as they noted, at a time when the industry in general has been witnessing layoffs.
Right. A lot of the big players have been flat or even shedding staff. So adding over 1,000 people net, that strongly suggests they're seeing real demand and are staffing up to meet it.
Confidence in the pipeline, maybe?
Confidence in the pipeline, confidence in the growth trajectory. They're investing in delivery capacity while others might be retrenching. It's quite a statement.
And it probably helps that their attrition rate is still very low, 11.3% over the last 12 months.
11.3% LTM. That's excellent for this industry. Really among the best.
They claim it's amongst the lowest.
I'd believe it. Low attrition is gold. It means
Right.
stability, experience retention, better client relationships because the teams aren't constantly changing. It speaks volumes about their culture.
Their utilization rate was also strong, 82.1%.
Pretty good level. Shows they're keeping their people busy on billable work.
And the location mix continues to shift. Slightly offshore revenue is now 52.3%. On-site is 47.7%.
A slight tilt towards offshore, which can help with margins too.
So drilling down a bit more, where is this growth actually coming from geographically and by industry?
Good question. Let's break that down.
Geographically, the Americas are the biggest piece of the pie, 56.7% of revenue.
Makes sense. Largest IT market.
And it saw the strongest growth, too, 13.7% quarter-on-quarter and a huge 72.4% year-on-year.
72% year-on-year in the Americas. Again, remembering the recasted base, but still massive growth in their core market.
Yeah. The rest of world segment also showed impressive growth, though smaller overall.
Okay. And by industry vertical.
The standout seems to be travel, transportation, and hospitality, TTH. That segment grew 31.2% quarter-on-quarter.
31% in one quarter.
Wow.
Yeah. Travel must be really bouncing back strongly for them.
And 92.2% year-on-year growth in TTH.
Okay, they clearly have some serious strength or specialization in that travel vertical that's paying off massively right now.
The others vertical, which lumps together healthcare, retail, high-tech, manufacturing, also grew significantly.
So growth isn't just concentrated in one or two areas. It seems fairly broad-based beyond TTH as well.
And another key area looking at service offerings was engineering services.
Right, that's become a huge part of their business, hasn't it? Especially with some acquisitions, I think.
Exactly. It contributed almost half the revenue, 45.9%, and grew 13.5% QoQ, an incredible 121.0% YoY.
121% year-on-year growth in engineering. That's clearly a major engine for them right now. It aligns with industry trends around product engineering, embedded systems, IoT.
So Strong performance across key geographies, particularly the Americas, and standout growth in TT and engineering services.
It paints a picture of focused execution in high-demand areas.
Okay, let's switch to the perhaps slightly less glamorous but crucial balance sheet and cash flow side.
Right, where the rubber meets the road financially.
Their cash and cash equivalents ended the quarter at US $81 million.
Okay. How does that compare?
It's down from US $125 million at the end of the previous quarter.
Okay, so a decrease in cash holdings.
Yeah, the net change in cash for the quarter was actually negative US $38.7 million.
A negative change. So they spent more cash than they brought in during the quarter.
Well, their operating cash flow, OCF, was positive, US $43.8 million. But the free cash flow, FCF, after accounting for capital expenditures, was negative US $21.5 million.
Negative free cash flow. Okay, that needs unpacking. Strong revenue and profit growth, but negative FCF. Why?
They did point to some significant outflows. Net capital expenditure, or CapEx, was quite high at US $65.3 million.
$65 million in CapEx in one quarter. Okay, that's a big chunk. What would that be for? Infrastructure, facilities, technology.
Likely a mix of those, investing in capacity and capabilities. There were also some smaller integration costs, like $0.2 million related to the Signity acquisition.
Right, M&A.
Costs, other acquisition expenses, and also a one-time bonus paid to employees, which was US $5.5 million.
Okay, so if you add up the heavy CapEx, the acquisition BICs, and the one-time bonus, you can see how that would eat up the operating cash flow and result in a negative free cash flow for the quarter.
So it sounds like it's driven by investment rather than poor operations.
It appears so, based on those numbers. Significant investment in CapEx, some acquisition cleanup, and rewarding employees. These are outflows, but arguably for future benefit.
Yeah.
The big question, though, is sustainability, meaning can they fund this level of investment and growth going forward? Will operating cash flow ramp up to cover it, or will they need more debt? What are their current borrowings?
Borrowings stand at US $87 million.
Okay, relatively modest compared to their revenue size. But still, managing that cash flow while investing heavily will be important to watch.
And despite the negative FCF this quarter, the board did decide to declare an interim dividend.
Oh, interesting. How much?
INR 4 per equity share for FY26. The record date is July 31st, 2025.
So, continuing to return cash to shareholders even while investing heavily, that's a balancing act.
One more small acquisition note. They have an agreement in principle to acquire ArtexMind SA.
Never heard of them.
It's described as a shelf company. Acquisition cost is tiny, around US $10,000.
A shelf company. So basically buying an existing legal entity, probably in a new country.
Exactly. They said its purpose is to enable faster entry into a new geography. Setting one up from scratch takes time.
Smart, tactical move for quick expansion if they have plans for a specific region, saves bureaucratic hassle.
So we see this picture of heavy investment CapEx, potential geographic expansion, acquisitions alongside shareholder returns.
Yeah, it reinforces that narrative. They're playing the long game, willing to use cash now to build scale, capabilities, and market presence for the future, while still keeping shareholders happy with dividends. It's a calculated strategy.
And just one final operational note. They're changing their registrar and share transfer agent to MUFG In Time India, effective this November.
Okay, an administrative detail for shareholders to note.
Right. So let's try and wrap this all up.
Right.
What are the main takeaways from this deep dive into Coforge's Q1?
Well, I mean, the headline is undeniably strong growth, outstanding revenue and profit figures, even considering the recasted base.
Backed by that really robust order intake and the growing order book.
Exactly. And the strategy seems clear. De-risking the client base, becoming less reliant on the very top clients.
And they're clearly putting their money where their mouth is regarding AI and global expansion. We see the investment there.
Absolutely. The AI initiatives sound practical, not just buzzwords. And the headcount additions plus low attrition point to a healthy core. They have the people to deliver.
So, operationally strong, strategically focused on growth and innovation.
Yeah, that's the picture. Strong execution, active investment. Even if it impacts short-term cash flow, like we saw this quarter, they seem focused on building for the next phase.
Okay, so here's a final thought for you, our listener, to mull over. We see Coforge investing aggressively in these AI platforms, using tactics like shelf companies for rapid expansion, and still committing to dividends.
Right, pulling levers for growth, expansion, and shareholder returns simultaneously.
So the question is, How do you think they'll manage the cash generation needed to sustain all this? What kind of trade-offs might be happening behind the scenes between investing for that high growth versus meeting shareholder expectations on profitability and dividends in the coming quarters?
Yeah, what does that balancing act tell us about their long-term vision and maybe their risk appetite? Something definitely worth thinking about as we watch their progress.